Gold isn't rising. The dollar is losing weight. That sounds like wordplay, but it's the core mistake almost everyone makes. You're told gold is soaring, that it's in a bubble, that prices have gone too far, but that assumes the dollar is stable. It isn't. Gold doesn't change. The unit measuring it does. When the price jumps, what you're really watching is purchasing power draining out of the currency you're paid in, save in, and plan your future around. This isn't theory. Between 1971 and 1980, gold moved from $35 an ounce to $800. Same metal, same ounce. The change was the dollar, which lost roughly 94% of its value. That wasn't a gold boom. It was a currency collapse, seen in reverse. Now, here's the part nobody says out loud. If today's gold targets sound impossible, it's because you're anchoring to a dollar that no longer behaves like money. And if that's true, the risk isn't missing the rally. It's misunderstanding what's already happening underneath you. So what exactly is this price action really signaling? What actually happened here didn't arrive as a single headline. It came in pieces, spread out just enough to feel normal. Gold pushed through old records. Central banks kept buying. Currencies, on the surface, looked calm. If you glanced at the euro-dollar exchange rate, it barely moved, sitting in almost the same range it occupied 25 years ago. That stability created the illusion that nothing fundamental had changed. But look closer. That calm cross rate isn't strength. It's two currencies weakening at the same time. When one falling object is measured against another falling object, everything looks stable. That's the trick. The real signal isn't in currency markets at all. It's in gold, because gold isn't part of the system being debased. This is where the story flips. What looks like an asset rally is actually a reference shift. The market isn't repricing gold higher. It's repricing currencies lower simultaneously. And that reframes every chart you've been shown. So here's the question that matters. If the dollar hasn't collapsed against other currencies, but has collapsed against gold, which signal is telling the truth? Because only one of them reflects purchasing power. Here's the claim that makes people uncomfortable. This isn't a speculative gold trade. It's a mathematical replay. In the 1970s, once the dollar was severed from gold, the adjustment didn't happen smoothly. From January 1971 to January 1980, the dollar price of gold rose roughly 27 times. That number sounds extreme until you strip away the narrative. The gold didn't change, the currency did. What looked like a bull market was a devaluation cycle expressing itself through price. Now apply that same math to the current system. Debt levels are higher, money creation is larger, fiscal discipline is weaker. If the dollar were to experience even a fraction of the same percentage adjustment, gold doesn't stop at 4,000 or 5,000. A move to 10,000 isn't aggressive. It's conservative. A full historical replay pushes the number toward 100,000. Notice what's missing from the mainstream conversation. No one is arguing the math. They're arguing how the number feels. That discomfort comes from anchoring to past prices, not from refuting the mechanism. And here's why that matters. Once the early resistance breaks, price discovery doesn't move linearly. In the 1970s, the most violent gains came late, not early. The higher the nominal price climbed, the easier each additional jump became. So the real question isn't whether these targets are believable. It's whether the conditions that produced them before are already in place again. What makes this moment different is how quietly it's escalating. There's no single shock. No overnight break. Instead, behaviors that once would have triggered panic are now treated as routine. Massive deficits roll over without debate. Emergency policies linger for years. Balance sheets expand, then expand again. We've seen this movie before. In the late 1960s and early 1970s, the US ran persistent deficits to fund war and social programs. Confidence didn't vanish immediately. It eroded. Gold didn't explode the day the system broke. It drifted, then crept, then suddenly repriced all at once. By the time the move looked obvious, most of it was already over. This is where the normalization becomes dangerous. Currency dilution has become background noise. Debt issuance feels technical, abstract, distant from daily life. But markets don't care how familiar something feels. They care about accumulation, and the accumulation is accelerating. Now watch how fast this escalates. Gold is rising without a currency crisis, without a stock market crash, without panic. That combination is rare. It suggests the system isn't reacting to fear yet. It's adjusting to reality. And if this adjustment is happening calmly, without stress, what happens when pressure finally shows up? The stronger evidence isn't in what's being said, it's in what's being done. Governments still describe gold as a relic. Officials repeat that modern systems don't need it. But behind the scenes, behavior tells a different story. Since 2022, central banks have been buying gold at the fastest pace in decades. Not ETFs, not paper claims, physical bullion, tons of it, and much of it moved quietly off the open market. Here's the contradiction that changes how you see this. At the same time, policymakers talk about confidence in fiat systems, they are systematically reducing their own exposure to them. Reserves that once sat in sovereign debt are being swapped for an asset with no issuer, no counterparty, and no switch that can be flipped off. Notice what they didn't deny. When reserves were frozen, when access was cut, when assets became political tools, no one claimed the system was neutral anymore. They simply adapted. This is where the narrative breaks. Gold isn't rising because investors are excited. It's rising because institutions with the most information are repositioning for a world where trust is conditional. And once that shift starts, it doesn't reverse easily. Because when words and actions diverge this sharply, only one of them is telling you where the system is actually heading. Now the pressure starts stacking. First, reserves get frozen. That tells every country holding foreign assets that access is no longer guaranteed. Then debt ratios quietly pass levels that once triggered crises, but nothing resets. Finally, alternatives disappear. Japanese debt is overloaded. European debt is fragmented. US debt keeps growing, but confidence is no longer unconditional. These aren't separate issues. They're compounding. Each one narrows the set of safe options, forcing more capital into fewer exits. Gold doesn't win by being exciting. It wins by being the last asset standing outside the blast radius. This is where speed matters. These relocations don't announce themselves. They happen in reserve statements, settlement data, vault movements. By the time the public notices, positioning is already done. That's why price moves feel sudden. They aren't reactions, they're revelations. And here's the destabilizing part. None of this requires inflation. None of it requires panic. It only requires uncertainty about access, solvency, and control. Once those doubts enter the system, they don't leave easily. So ask yourself this: if trust keeps eroding and options keep shrinking, what happens if this continues? At some point, this stops being abstract and starts landing in your life. If gold is repricing because currencies are weakening, that shows up everywhere else. The cost of housing doesn't feel high because homes suddenly became better. Food doesn't feel expensive because it improved. What's changing is the unit you use to measure value. Your paycheck buys less. Your savings cover fewer months. Long-term plans start feeling fragile even if nothing crashes. You're told this is temporary, transitory, a cycle. But cycles don't last decades, systems do. And when a system slowly drains purchasing power, toggle by toggle, people adjust without realizing what they've accepted. Smaller portions, longer hours, more debt to maintain the same standard of living. This is where gold matters to ordinary people, not as a trade, as a signal. When institutions protect themselves against currency risk, the effects eventually reach households that can't hedge the same way. If this feels familiar, say so in the comments. Because the most important part isn't whether gold goes higher, it's what its behavior is revealing about the ground you're standing on. And once you see that, you start asking a very different kind of question about what comes next. Here's the calmer, more unsettling layer underneath all of this. Systems don't fail because everyone panics at once. They fail because incentives quietly realign. Debt-heavy governments are incentivized to inflate, not default. Central banks are incentivized to maintain stability optics, not purchasing power. Financial markets are incentivized to reward leverage, not restraint. None of this requires bad actors. It only requires rational behavior inside a strained system. Gold sits outside those incentives. It doesn't need growth. It doesn't need confidence. It doesn't rely on someone else's promise to pay. That's why it behaves differently when pressure builds, not explosively, persistently. This is why mainstream coverage struggles with what's happening. News is built to explain events. This isn't an event, it's a mechanism, a slow transfer from trust-based assets to bearer assets, from promises to weight, from systems that depend on coordination to assets that don't. Here's why that detail changes everything. If gold is moving because of structural incentives, not fear, then volatility isn't a warning sign, it's noise. The signal is consistency. And once a system begins rewarding exit over participation, the direction tends to hold far longer than people expect, which brings us to the part everyone wants answered next. From here, the path splits, but neither option is calm. One path is gradual, debt keeps growing, currencies keep losing purchasing power quietly, markets adapt, gold continues higher, not in a straight line, but with steady pressure, as more capital treats it as a permanent allocation instead of a trade. In this path, nothing breaks suddenly. It just becomes harder to maintain the same life with the same inputs. The adjustment feels slow, almost polite. The other path is faster. A policy mistake, a political shock, a loss of confidence that forces intervention instead of gradual drift. In that scenario, repricing accelerates. Moves that once took years happen in months. Price discovery turns violent, not because gold changes, but because the measuring stick does. Neither path requires a prediction. Momentum is already in motion. The only uncertainty is speed. And markets are forward-looking. They don't wait for confirmation. They front-run stress. That's why this moment feels tense even without headlines screaming crisis. Something is already forming just beyond the frame. And the final question isn't which path happens. It's whether you'll recognize it while there's still time to adjust. The mistake is thinking this story is about gold. It isn't. Gold is just the clearest mirror. When everything else depends on trust, leverage, and coordination, the asset that requires none of those starts telling the truth first. Rising gold prices aren't forecasting wealth. They're revealing strain. Not tomorrow. Now. The deeper insight is this. Currency strength is relative. Purchasing power is absolute. A dollar can look stable against other currencies and still be collapsing against real value. That collapse doesn't announce itself. It shows up quietly in ounces, not headlines. This is why the move feels confusing, even unbelievable. You're trained to wait for crisis before rethinking assumptions, but systems rarely give that courtesy. They adjust first. Explanations come later. If you want to understand what happens next, you don't watch speeches or forecasts, you watch behavior, you watch what institutions do when words no longer protect them. That's what this signal is. If you want continued analysis as this realignment unfolds, follow and subscribe. This isn't a one-off event, it's a shift, and the next layer is already forming.